At the front of most investors' minds is the question of risk. Well, investment companies differ in terms of the range of risk. Most of them invest in assets such as shares, which are relatively high-risk investments which can fall as well as rise in value. So investment companies should be held for the long term. But as a potential investor, it's a good idea to take a closer look at how these investments work to understand the benefits and the risks. Investment companies, unlike other funds, can use something known as gearing. Gearing means borrowing money to buy more assets, in the hope that the returns on those investments will be greater than the costs of borrowing. Used well, gearing can boost capital growth or dividends for you. But gearing comes at a risk. If the investment company's portfolio falls in value, it can increase losses. However, you should remember that investment companies tend not to use high levels of gearing, and in fact many use no gearing at all. Another key word is discounts. Shares in investment companies are bought and sold through the stock market, so the price that you can deal at may not be the same as the value of the underlying assets of the investment company. The difference between the two is known as a discount or a premium. Now, if the share price is below the value of the underlying assets, the shares are said to be standing at a discount. If the share price is above the asset value, it's said to be standing at a premium. So depending on when you buy or sell, you may end up getting a price that's better or worse than you might expect.